Ladies and gentlemen, good day and welcome to Ujjivan Small Finance Bank Q4 FY24 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikin Shah from IIFL Securities Limited. Thank you and over to you, sir.
Thank you, Muskan. Good morning, everyone, and welcome to Ujjivan Small Finance Bank's Q4 earnings call. I'm delighted to welcome the entire management team of Ujjivan Small Finance Bank, who will discuss the earnings and the business performance, followed by interactive Q&A. The management team is represented by Mr. Ittira Davis, MD and CEO, Ms. Carol Furtado, Executive Director, Ashish Goyal, Chief Credit Officer, MD Ramesh Murthy, Chief Financial Officer, Martin PS, Chief Operating Officer, Vibhas Chandra, Head Microbanking, and Sanjeev Nautiyal, Company Secretary and Head of Regulatory Framework. With this, let me pass on the call to Mr. Ittira Davis. Over to you, sir.
Thank you, Nitin, and good morning and welcome to our Q4 earnings call. I'm pleased to announce that Q4 has been another strong quarter for the bank, closing the financial year on a strong note. The bank has raised the bar to improve benchmarks, which is evident through its healthy growth and strong profitability. There were several developments post the book closure. As you know, we have received RBI approval for the appointment of Mr. Sanjeev Nautiyal as the Managing Director and CEO of our bank with effect from 1st July 24. He will join us on the 1st of June as President in the interim. He is a seasoned banker with over 3 decades of extensive experience in retail, SME, financial inclusion, operations, HR, international banking, and treasury. Previously, Mr. Nautiyal held the position of Deputy Managing Director in State Bank of India, handling financial inclusion and micro markets. And also, he was earlier Managing Director and CEO of SBI Life Insurance. I will be stepping down from MD and CEO position with effect from June 30th, 2024, but will continue to be associated with the bank as an advisor. With the approval of the RBI, Carol Furtado has taken over additional responsibility as full-time director. She is now an executive director of the bank with effect from 1st of May 2024. We have successfully completed the merger process between the bank and the holding company. The shares will be credited to the shareholders of UFSL and trading is expected to start this week. Here I would like to highlight that the merger has benefited all our shareholders. The book value per share has increased by rupees 2.6, resulting in a book value per share of rupees 29.06 as of March 31st, 2024. Additionally, owing to the strong profitability of the bank for financial year 24, the board has recommended a final equity dividend of rupees 1.5 per equity share. This will be subject to shareholders' approval in the ensuing AGM. Speaking about business, we continue to expand our presence geographically. We have added 123 branches during the financial year, taking the total branch count to 752, spread over 26 states. We aim to add around 50 more branches during financial year 24-25. During Q4, our loan disbursements stood at 6,681 crore, growing 11% over the last quarter. This resulted in full-year disbursements reaching 23,389 crores with a registered increase of 17% year-on-year. Our gross loan book grew by 24% year-on-year and 10% Q-on-Q. Customer acquisition remains strong and we have acquired around 2.7 lakh new microfinance customers in the last quarter, taking the total count of newly acquired customers to 10.5 lakhs for financial year 2024. This is around 12% higher than what we acquired in the previous year. This increasing acquisition reflects the untapped potential of the customer segment. We have graduated about 1.4 lakh customers from group loan to individual loans in financial year 23. And the individual loan growth will continue to outpace group loan growth. More than 80% of the current IL customer base are from our existing GL customers who continue to have good record and thus were graduated to the individual loans. We see strong demand and believe this trend should continue in financial year 25 as well. The growth in affordable housing, including micro mortgages, continue to be strong. We dispersed 730 crore for fourth quarter and 2,284 crores for the full year, witnessing a growth of 45% on a year-on-year basis, and our book is now a 5,000 crore book on the affordable housing. We had piloted a new LOS for the affordable housing vertical in Q4 24, which was successfully launched across the country in April this year. This will help us improve efficiency, reducing manual interventions, enabling digital onboarding of customers, improve productivity, and streamline the approval process. We have added pre-qualified top-up loans to the product suite for our existing customers, and a number of our existing customers are already eligible for this loan. Similarly, our micro mortgages book has grown well. We see this momentum to continue in the next year as well. With regard to the MSME business, the transition is nearly complete. We dispersed 128 crores in the fourth quarter, which is a significant improvement from just 24 crores in the first quarter. Our new pan-India MSME book largely comprises of LAP products. The LOS for the same is planned to be launched in the first quarter. This will lead to significant improvement in critical metrics such as productivity, turnaround time, etc., helping us scale the product much faster. Financial year 25 will also witness countrywide launch of fund-based and non-fund-based working capital offerings. To further augment the product offerings, we are closely working with 4 fintech partners, of which 2 are already onboarded in the fourth quarter. And as supply chain finance business from fintech partners gains traction, it will add to the growth of the MSME vertical, as this is a high-yielding book. Our FIG business continues to contribute to our secured base with quarterly disbursements of 546 crores in the fourth quarter. We continue to invest in our emerging businesses such as gold loans and vehicle finance business. Gold loan will now be offered from 250 branches by the end of financial year 25, up from 60 currently operating branches, and vehicle finance will deepen its presence in the existing 8 states to more traction to grow their business. We will continue to invest in technology and human resources to make products readily to be scaled up. In line with our long-term objectives, we continue to grow our secured book, which increased to 30.2% as of March 24, up from 28.3% in the previous quarter. Q4 has been a strong quarter on the liabilities part as well. Total deposits have grown strongly to 31,462 crores, registering a 23% year-on-year growth and a 6% quarter-on-quarter growth, reaping benefits from our increasing branch presence, enhanced service levels, and improved business productivity. Additionally, our focus towards retail deposits has helped us garner 778 crores of CASA this quarter, registering a double-digit growth of 10% sequentially. Our total CASA book now stands at 8,335 crores. Our CASA ratio improved to 26.5 against 25.5 in the last quarter. The benefits of brand campaigns and introduction of value-added products during the year has also fueled this growth. Our retail term deposit growth continues to outpace bulk term deposit, growing by 7% and 36% for the quarter and the year respectively. We have recently increased our term deposit rates by 25 basis points for the 15 months deposit bucket to offer a more competitive rate to our customers. We believe the key to expand our customer base and reaching a diverse set of customers lies in embracing mix of physical and digital journey. Two digital liability products, namely fixed deposits and savings accounts, were introduced during the second half of the financial year, mobilizing 75 crores of deposits. During the first quarter of this financial year, we will be introducing digital initiatives such as smart statements, video banking, and WhatsApp banking. Furthermore, we aim to offer end-to-end digital services experiences for our customers in select areas. In financial year 25, we will continue to invest in targeted brand campaigns. The focus towards building retail and granular deposit base and leverage our digital channels will continue. Additionally, our MSME business will also contribute towards building current accounts as the asset product suite is designed towards meeting our customers' requirement. We will also offer escrow accounts to our current account customers. Our Hello Ujjivan application is gaining acceptance among our customers with total downloads reaching around 7.8 lakhs. The loan acknowledgement from our repeat and top-up group loans has also started to pick up. A total of 1.28 lakh loans were acknowledged this quarter, which forms 33% of total repeat and top-up group loans. We are also exploring offering insurance products via Hello Ujjivan, currently offering one insurance product, but we hope to add a few more in the future. Now a look at the financials and margins. This quarter, we were able to benefit from our past efforts, resulting in expanded margins. The expansion was a result of three factors: improved cost of funds, optimal system liquidity, and continued benefit from asset book repricing. The resultant NIMs for the quarter was 9.4% against 8.8% in Q3 and 9.1% for the full year 24. And this is in line with our previous guidance. While the asset book repricing will continue to benefit us, the cost of funds will stay elevated as a result of our recent hike in the 15-month deposit bucket. The cost of funds for the quarter was 7.2% against 7.5% in the last quarter. There is also a one-time benefit of 17 basis points in cost of funds due to interest reversal on the term deposit post the reverse merger. Currently, around 75% of the book is in the highest bracket, while around 15% of the book sourced between September 22 and February 23, and 10% of the book sourced pre-September 22 is yet to be fully repriced. The cost-to-income ratio for Q4 24 remained at 56%, slightly elevated as investments in infra and technology continue. Going forward, we believe it will remain at similar levels as investments continue to form a strong base for the bank. Pre-provision operating profit remains strong at 519 crore, growing by 26% year-on-year. Coming to asset quality, the collections continue to be strong around 99% levels. The credit cost continues to move towards normalized levels. Credit cost for the quarter is 79 crores versus 63 crores in the previous quarter. Our asset quality remains robust with GNPA at 2.1% and NNPA at 0.3%. Slippages for the fourth quarter were at 175 crores against 140 crores in the third quarter. For FY24, slippages are at 480 crores with upgrade and recoveries of 224 crores. Bad debt recovery remains strong at 141 crores in financial year 24. We have written off 65 crores during the quarter. We had guided for a credit cost of sub 100 basis points for the last financial year, and the bank remained well within the guidance. During the second half of financial year 24, we have seen credit costs normalizing. This includes an external factor of loan waiver campaigns in some specific pockets of northern India. Further, as the book vintage increases and with credit cost normalization continuing, We expect credit costs to be in the range of 1.4% to 1.5% for financial year 25. During FY24, bad debt recovery was 141 crores on the back of strong collection team and intensified legal activities. We will want to continue these initiatives during the current year as well and expect to recover around 100 crores. PAT for the quarter was 330 crores, resulting in a full year profit after tax of 1,281 crores, growing by 17% year on year. This has resulted in a healthy return on assets and return on equity of 3.3% and 24.8% for the fourth quarter. For the full year, return on assets is a remarkable 3.5% and a very good 26.1% for ROE for the financial year 24. RBI has recently outlined the eligibility criteria for qualifying to apply for the universal bank license. We are pleased to confirm that the eligibility criteria will come out as planned, basis the board guidance. Now, a guidance for the current financial year. We estimate our gross loan book to be growing between 20 to 25% for financial year 25, while deposits will grow in line with our asset growth, and our CD ratios will maintain those of the financial year 24 levels. Later in the year, a firmer number will be given on the exact growth, whether we are on the higher end or the lower end of the 20 to 25% growth. Financial year 24-25 will be a year of sustained business performance and profitability. We expect NIMs to stay around the 9% and the ROE at around 22%. These are early indications, as I said, with firmer guidance to follow at the half-year mark. Thank you. Over to you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good morning. Congrats on good quarter. So my first question is on the asset quality. So while the slippages run rate was slightly higher in the quarter, it could be because of Punjab, but the upgrades and recoveries quantum was quite lower in Q4. Any specific reason why upgrades and recoveries were lower? And second associated question is, we are continuously seeing reduction in on-roll and off-roll collection team in micro banking. Can it have any future bearing on collection efficiency, maybe OD collections or maybe NPL recoveries and upgrades?
Okay. I'll answer the first question, which is our slippages. So if you have noticed, our slippages have consistently been, in the range of 0.5%. There was a minor reduction. I would not say a reduction in the fourth quarter, and there is no specific reason for that. It has been more or less flat. As far as the team size is concerned, we had actually increased the team size in Q3 and we brought it back to the normal level in Q4. So you would see a Q-on-Q reduction, but the team has been based on our assessment of the overall book to be recovered. So we see that this number will continue. So this, the collection team strength is expected to continue during this financial year.
Okay, so you are implying that this credit cost guidance of 1.4, 1.5 kind of captures a very usual steady state slippages as well as upgrades and recoveries run rate going forward, right?
In fact, we had even last year said that we will be seeing normalization of the credit cost, and we saw that the credit costs were normalizing quarter on quarter, and we expect that this will be a steady state going forward into FY 25.
Okay. And just on the average ticket size across products, when I look at affordable housing, excluding MLAP, when I look at MSME, excluding fintech channel, there has been some increase in ticket sizes when I look at Y and Y comparison. So anything specific which is driving here? That's number one. And second is this cost of deposit which fell this quarter, and just there was a one-time benefit of interest reversal. So excluding this, how would have cost of fund moved in this quarter?
Okay, I'll take the ticket sizes first. The average ticket size in group loans has gone up marginally. New customers' contribution reduced from 43% to 39%, and we saw an increase in the repeat loans from 32 to 39%. The increase in ticket sizes in group loans is in individual loans. Ticket sizes have increased across as we are graduating group loans to individual loans at a higher ticket size. This increase was about 3%. So it's not a very significant increase in the ticket size of individual loans.
No, my question was on the ticket size of affordable housing X of MLAP and MSME X of fintech, which we show in the presentation. So they have gone up.
So affordable housing, the ticket sizes, in last year was about 12.6 and we've seen a 14.2. So that's a marginal increase. The 14 lakhs is what we are normally underwriting these days. The range remains, however, between 12 to 15 lakhs.
Okay.
Most of our business is coming from that business segment of 12 to 15 lakhs. Now it could be slightly on the 14 lakh range or the 13 lakh range, but that's not a significant movement. The band remains the same. The customer segment remains the same. On MSME, yes, we have seen a slightly higher ticket size. We launched the LAP product in Q1, and that has stabilized over the last 4 quarters. In the last quarter, we saw a significant traction, and we want to be in that range of 40 to 50 lakhs. So that's the segment in which we've started to see the scale up happening. We see that we will continue to operate in the range of 40 to 50 lakhs.
Sorry, I just missed it.
We see that we will continue to operate in the 40 to 50 lakhs average ticket size for LAP loans.
Okay. Yeah. Thank you and best of luck.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit a question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity. Firstly, on MSME loan, can you explain? Can you give some details on the fintech partnership that we have? What is the book size that we have from that partnership? What are the average needs, etc. And what is the customer profile that we are targeting in the MSME fintech vertical?
MSME fintech, we recently started this portfolio and we have already tied up with 2 partners and there are 2 in the pipeline. And the book size is very small. We are also hoping to grow this through the fintechs and also on our individual capacity.
Okay, sure. And in the MSME vertical, what is the origination strategy? How are we originating these loans?
So this is a combination. We are doing the semi-formal LAP. We restarted the portfolio sometime in May of last year. And our strategy is to get customers from the semi-formal, semi-urban areas and grow the portfolio there.
Okay. And how should we think about the cost of funds going forward? This quarter, there is one-off. So adjusted for one-off, probably the cost of fund is 7.4% roughly. How should we project cost of funds in FY25?
Monthly cost of funds will see a marginal uptake because we have recently announced a rate hike. TD rates have increased by about 25 basis points in March 24. However, when compared QOQ, we have seen a substantial reduction in cost of funds. We have earlier said that around 17 basis point reduction is due to interest rate reversal on the holding company deposits. And while the balance 8 basis points is due to improved CASA and retail deposits. So our view is until the repo rate starts coming down, we assume the cost of funds to remain elevated. We don't wish to predict as several external factors come into force on the cost of funds.
But from a modeling perspective, we should start with 7.4% as a starting number, and there should be a marginal increase in cost of funds from that number in FY25. Is that right?
Yeah, more closer to around 7.3 because of tighter treasury management.
Sure. Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Pritesh from DAM Capital. Please go ahead.
Hi, good morning. Just two questions. One is on this FIG lending, which we have seen a very strong growth. So if you can give some color, what comfort we are having there, was it just a liquidity deployment, is it short term, long term? If you can give some color on that.
So the FIG lending is doing well for us. We have grown, substantially there. Our portfolio size is around 1730 crores. We will be taking this up a little further to balance our secured asset book. And the customer segments would be the NBFCs that we are targeting and A-rated companies and AA plus rated companies.
Sure. If you can just mention what kind of yields we will be getting there, and is it short term or is it like a sustainable? As you said, you'll increase it, but the lending which has happened is short term in nature or a decent tenure.
So on the FIG portfolio, we have exposure coming in from NBFCs lending to MSMEs, vehicle finance, education sector, and gold loans. So these are the four. The tenors on all these four segments are different from each other. MSMEs are a slightly higher tenor and gold loans are much on the lower side. The yields again are risk calibrated because 95% of our portfolio remains in A and above. So therefore the yields are slightly on the lower side, but it is risk-based pricing. And we've not diluted the portfolio. It continues to be in the range of 93 to 95% A and above.
Got it. Second question was on other OPEX growth. We've seen this a high growth this quarter. Any one-off there, and will we see such run rate because suddenly this quarter has been seen as sharp uptick?
Yeah, I think, the other operating expenses, there's been HR costs which have been slightly higher because we have made some adjustments. And also the premises cost because we opened quite a few branches in this part of the year. So it is something that is there, and the OPEX cost for the branches will continue primarily by way of rents, and the salaries will continue also because that's part of the process. We have also had some IT expenses which are project related. Some of the IT expenses will continue as we upgrade because, as you know, the regulator is now very, very keen to make sure that the technology is in line with what you're offering and the customers benefit from that and not lose out. So we are ensuring that our technology is state of the art and will come up to the regulators' expectations. So yes, going forward, these are things which I think all banks, the whole industry has to take note of, and then I think it is something that is very important. So we will be investing in that.
Got it. Lastly, we mentioned about liquidity usage this quarter. How much going ahead we tend to use more, I mean the LCR. So what will be the base case scenario? We'll keep or will not breach that number?
No, breaching LCR is not a question. We cannot afford to breach it. So that is now whether
we have about 130% something right now, and will it be at the similar levels or will it go a little bit further down or will increase the LCR? What is the stance on that?
Our average is to maintain it around 140, 150. That's so 134 is good, 140 is good. That's the level. Not too much liquidity, but at the same time, something which is reasonable and good and safe.
Got it. Thank you so much. All the best.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good morning and congratulations. Two questions from my side. One is just a data keeping one. Can you share what is the outstanding technically written off book as on March 24 and also on March 23 if you have the number handy?
Sorry.
If you have the technically written off book available as on March 24 and March 23.
In March 24, it is in the range of about 1100 crores. That's the total book, written off book. But this consists of what we have done in the last 2 years, plus what we had done during COVID time.
Understood. Would you have the number available for March 23 as well?
I'll just come back to you.
Okay, sure. And secondly, the secured book is now at roughly 30% of the overall advances. How do you expect this to trend over FY25 and 26?
Oh, sorry.
So the guidance given for the 2 years is around 60-40. 60 would be in the unsecured and 40 secured. We will be meeting that guidance in the next 2 years. We've already reached 0.2 and we are seeing an increasing trend there. We've also introduced two secured asset verticals like gold, vehicle finance, MSME in the revised strategy, doing well for us.
Understood. And if I can just squeeze in one last question, how are we accounting for the income from the off-balance sheet book, the IBPC and securitized loans?
On securitization, we take it into income. IBPC helps us in containing our cost of funds.
Okay, but the interest spread from the off-balance sheet book, would that be booked upfront or will there be a
It's on a cash basis, we don't accrue this.
Okay, but you book the interest spread or the entire interest income and interest expense separately?
You're paying for this, IBPC is a source of funds for us.
Okay, perfect. I'll take this one offline. Thank you.
Thank you. The next question is from the line of Rinesh from ICICI Securities. Please go ahead.
Yeah, hi sir. Just two questions from my side. One on the individual loan side. So we've been growing this piece at pretty accelerated pace from last 5-6 quarters. So can you just throw some light on, let's say, the PAR portfolio or maybe some sort of asset quality indicators in this book?
For individual loan, these are customers who have mostly graduated from group loans. We do about 10 to 12% of open market acquisition on the individual loan side. Most of these customers have a 2 to 3 year track with the bank. So the asset quality for individual loans is better than the group loan asset quality. And that has also given us the confidence of growing this at a rate of 40%.
Okay.
So in terms of PAR, it's lower than the group loan PAR. Our average remains to be in the range of 1.3, 1.4.
And what are the yields we charge under this loan?
Yield. You know, it is again risk-based pricing that we do. The yields would be somewhere in the range of the group loan yields.
Okay.
Marginally higher, but probably in the same band.
Got it. Got it. And my next question is on the NIM guidance, which we have given of 9%. Now, given we intend to grow our secured book at a faster clip over next 2 years, so how do you see this NIM behaving over next, let's say, 6 to 7 quarters? I mean, naturally, your yields and the secured book will be lower. So how one should look at the NIMs going ahead?
Yeah, as the secured book increases, NIMs will come under a little pressure. But recently we have got an upgrade on the on the rating from the rating agencies. So we will be using that to manage our costs, and also using treasury to manage the fund process. So hopefully it will not be much lower, but it depends on how fast the secured asset book is building up. So we'll keep the market advised as to if we see any changes coming up. But for now, go with the guidance of 9%.
Okay. Okay. And lastly, on the deposit growth run rate. So in PPT, we did mention about our deposit growth rate will broadly track the loan growth. But when we look at the CD ratio, which is still at 95-96%, doesn't it calls for a accelerated deposit growth than loan growth in near term?
Yeah, in the fourth quarter, our deposit growth was quite good, and we see that continuing into the first quarter. So yes, I mean, our intention is to make sure that our CASA ratio, etc., moves up. Our target internally is towards the magic number of 30. But yeah, in terms of the CD ratio, actually, based on the thing, it is 87%. Of course, if you adjust it for the IBPC, then it's slightly higher. But for all practical purposes, IBPCs are used to manage CD ratios. So I think you should look at the 87 rather than the 94, because that's how the regulator looks at it.
Okay. Okay. Thank you, sir.
Thank you.
Thank you.
The next question is from the line of Kruti Divarajke from Laburium Capital. Please go ahead.
Hi, good morning. I just wanted your overall view on the MFI cycle. Are there any early warning signals you're seeing in any geography? And even the loan waivers that you spoke about, was it contained in particular geographies in Northern India, or you saw it spreading out more than what it initially thought?
Could you kindly repeat the question? The voice was not very clear.
Hi, can you hear me?
Yes. This is better.
Yeah, I wanted to know your view on the MFI cycle.
Sorry, ma'am. Sorry to interrupt. Can you speak a little louder, or you can use handset, please?
Hello? Better?
Yeah, it's little bit better.
Yeah, I wanted to know your view on the MFI cycle, if you're seeing any early warning signals in any geographies, and even the loan waivers that you spoke about in Northern India. Was it contained in particular geographies, or did you see it spread more than what you had initially expected?
Yeah, okay. In some pockets, we have seen, especially in Punjab, Haryana, as you mentioned, that the portfolio to some extent is impacted due to Karja Mukti Abhiyan in the second half of financial year 24. We expect this to subside by Q2 onwards. Our portfolio, overall is performing well, as we are mostly into urban and semi-urban, but seems to be a temporary thing.
And apart from these loan waivers, you don't see any signs of any early warning signals in other geographies or for some other reason?
So apart from there, our portfolio in Kerala has little underperformed, and it is at industry level as well, and to an extent in Tamil Nadu as well. And we have slowly we have little slowed down also our NCA strategy here to contain our repeat loans and repeat customers. But it is something which again I would say that it is kind of temporary in nature, but we need to take cautious steps to ensure that our portfolio is safe.
Can you sort of pinpoint a reason for Kerala and Tamil Nadu underperforming, an industry level reason maybe?
So there is no specific pockets. It's Kerala that is, we have limited number of branches, limited presence in Kerala, and at industry level also we see a little stress and kind of little over borrowing. And as a cautious step, we have little slowdown in Kerala. But as far as a specific pocket where concerns are raising out, there is no specific pocket.
Got it. Got it. And my next question is on other income. So we've done really well on the other income. There's been sort of a catch up with more focus on cross-sell. Treasury has done well. Going forward, do we expect this line item to continue outperforming in the next year? Or do we now think it will grow in line with either disbursements or NII?
The other income will mostly be in line with our business growth, and we see insurance as an area where we could do well, including the PSLC and maybe a few more third-party products would come into the picture. This is a line item that would continue doing well for us.
I think there was, in terms of the full year, there was a one-time effect in the insurance income. That will not be there in the current year. That's about 30 crores.
Got it. Got it. If can I just ask one more question? If you expect any operating leverage to play out in the next financial year, because I think you have upped the, sorry, what is the number you have given for the number of branches that you want to open in FY25? And then related question on operating leverage, if it's going to play out this year.
Number of branches next year is, FY25 is 50 additional branches, 50.
Got it. And overall operating leverage at the company level, do we expect in FY25?
What is your definition of operating leverage, sorry?
If cost to income will fall below 55%.
Yeah, okay. Yeah, cost to income may tick up a little bit. As I said, we have got additional costs which we have put in place because of the manpower requirements and the competition in the market, and the market is a bit heated, so that will have some impact. And also the premises costs, which will be slightly elevated compared to the previous year. However, you can be rest assured that we are currently among the best in terms of cost income in the small finance bank industry, and we hope to remain in that position or near the 1 or 2 in terms of the best in terms of that ratio.
Sorry, thank you so much.
Thank you. The next question is from the line of Shailesh Alkani from Centrum Broking Limited. Please go ahead.
Good morning, everyone, and thanks for the opportunity. So, all my questions are answered. Only one question. Sir, on the recovery front from return of accounts, we had guided during the start of the year that the number would be lower than last year, but this year we have done well. So, any guidance on that front? How will be the recovery from the return of accounts?
Last year said that we will probably try to achieve about 120 crores, 110 to 120 crores. But during the year, we found that we had a very favorable environment in terms of the intensified legal initiatives that we had planned during the year. So on the micro banking side, we had Lok Adalats, so there was a very supportive environment there. And most of the recoveries that we've got from the written off pool has been from either micro banking or from the affordable housing segment. So it is because of the increased traction on Lok Adalats and sale of possessed assets on the housing side that we were able to get a slightly higher number than what we had initially thought. This year again we are saying this year we are talking about anything between 100 and 110 crores. The earlier pool which we had written off during COVID is now quite aged, so we expect much lower recoveries from there. But from the written off pool, which is immediately in the last 2 years, we'll probably get much higher recoveries. So something in the range of 100 to 110 crores is what we'll target this year.
Okay, thanks a lot. That's useful. So just last question on my side. Since our individual lending book has grown very smartly this year, and some of our peers have taken CGFMU cover. So is the management contemplating anything on that side, and any views if you can share with us?
We've had meetings to understand the entire CGFMU, product, the entire offering. We are continuing a discussion with them, but we don't see that happening in at least the first 6 months. If at all we decide to take the CGFMU cover, it will be in the second half. But nothing decided as of now.
Okay, sir. Thanks a lot. And best of luck.
Thank you. The next question is from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah, thank you, sir. So the question was related to the refinance that we are availing. Number has, slightly come down. So if you can, elaborate on that, what is the plan that we have on the refinance availment? Yes, sir.
Yeah, the refinance that we are taking, from the various agencies, we are in discussion with the National Housing Bank and a few others. So we expect during this year there'll be an increase, but our loan book is also growing. So if you look at it as a proportion of the loan book, you might think that it might be coming down, but absolute numbers will be increasing. And wherever it is advantageous for us and wherever it makes sense, we will be looking at the refinance. But the refinance doesn't come cheap; it's quite expensive. So, we have to manage the cost as well. But it's a good source to have as a backup.
Yeah, so just to get a different, a differentiated view that what is the, the cost of borrowing that we have excluding refinance and for the refinance itself, if you can provide us the figure, the borrowing cost for both these things.
We'll take that offline, and my colleagues will get back to you.
Sure, sir. Just a related question, sir. Other than big lending, we have almost all the loans against which we can get a refinance. So, is there any any issue that we are not we are not going ahead on this front, or if you can tell us, because I'm not able to understand that why we are not going ahead with this refinance thing so much. So if I add your IBPC, I don't know, because the number is club, IBPC and securitization numbers is club. So if I take the IBPC number and your refinance number as a percentage to your assets, basically your loans against which you can take this refinance, that number looks quite low as compared to other banks or the peer set. So just to understand that, that's slightly better, sir.
Yeah, IBPC we have around 2,500 crores. So 2,360 to be precise. And from other sources, it's not very much. But as I said, it's the costs which we have to consider. You see, the thing is that we are very highly capitalized. So the thing is that with a 24% CRAR and all that, we don't really need this refinancing as a source, because net it's a bit expensive. As I said, we have to look at the cost of funds. We cannot just do refinancing for refinancing sake. It has to make sense. And also, when there is an asset liability mismatch, yes, some of these refinancings are useful, and we will do so. As we grow our MSME book and our housing loan book, yes, we will revert. We will be looking at these refinancing to take care of the maturity mismatch. So yes, going forward, you'll see more utilization of those sources. But for now, with our present level, we are quite well funded.
Just another point here, sir. Just sorry to extend this further. So it can also help you in the LDR number, basically, so the more refinance that you take, it will help you at that front also, I think.
Which number, sorry?
So the higher refinance number can also help at the LDR level, right? LDR calculation. So actual LDR, which I think regulator will consider as compared to what you report, in general. So higher LDR, it will get, like, to that extent, your LDR will also look lower.
Okay, no, we'll take your point. We'll, have an internal discussion with the Treasury and others and see whether it really will help us. But yeah, no, good point.
Thank you, sir. Thanks a lot, sir.
Thank you. The next question is from the line of Mahesh Kabra from BSK Group. Please go ahead. Yes, please, Mr. Mahesh, go with the question. Hello.
Hello.
Yes, please go with the question.
Yeah, good morning, sir. My question is about the dividend. We are distributing almost this quarter's profit as dividend, and with the growth that we are projecting, soon we would need probably more capital to raise. My question was about dividend. What is the idea there?
Our profitability has been good. In fact, if you see the level of profitability, the CRAR has been able to keep up with the profitability levels and take care of the asset growth. Now, recently, the RBI had asked for additional capital to be put aside against some of the consumer lending, which is why there's been a slight adjustment in the CRAR. But we have enough profit generation, to take care of the growth in the balance sheet, and we don't anticipate, based on our current growth expectations, to be coming to the market for any additional capital in the near term. Regulatory requirement is 15%. Internally, we have kept a guideline at the board level of 20%. We are at 24%. So I think, there is adequate cover there. And during the 24-25, we don't need any additional capital, which is required for building the balance.
Yeah, I get that. Probably we won't need capital even in 25-26, but 25% growth in loan book and approximately 15% growth in net worth with 20% or ROE and dividend distribution. Probably 2.5-3 years down the line, we will again have to raise capital, right? Am I right here?
Yeah, 3 years down the road, yes. That is on our target. So from time to time, we'll have to raise capital. So are you suggesting that we don't declare any dividend?
I mean, being banking company growing at 25%, I thought conserving capital would be better. You are expert, I'm not. I'm just understanding your thought process.
No, but the industry is giving a reasonable level of dividends. We have to also, our profitability is good. We are not giving, exorbitant dividends. We are giving something reasonable. Maybe on the higher end, people do it between 12 and 15. We are on the 15%. But, that is an annual feature which the board has to decide from on an annual basis. For this year, it's the highest profit, so 15% was decided.
Yeah. Thank you, sir. Thank you. And congrats on the good set of numbers.
Thank you. Thank you.
Thank you. The next question is from the line of Yash Dalvi from Systematic Group. Please go ahead.
Yeah, good morning, sir, and thank you for giving me this opportunity. So I had two questions. So since we have recently added two fintech partners for MSMEs and two in pipeline, so assuming the both of them are added, how do you expect the MSME group to grow? And second would be that any expected date by which we can expect the shares to be credited? If you could guide on that.
So MSME through the fintechs, through our revised strategy, we will be growing as expected. And the last year we did a lot of strategy, relook at it, also on our customer segments and all that. And we've opened up a lot of product lines. We should be able to see a good growth happening in this financial year. This would also be a good enhancement to the growth of our current account book. So all in all, we are seeing a good uptake in the MSME book this financial year.
On the commencement of trading.
Pardon?
On the commencement of the trading. Okay.
The share trading, just one moment. Go ahead.
On the commencement of the trading, we are in receipt of the in-principle listing approval from the exchanges. Last Friday we received it. As we speak, we are initiating our corporate action documents with CDSL and NSDL. We are very positive from tomorrow you will get the shares credited into your account, and the trading approval will be received in a day. So possibly by Thursday or Friday, we are very positive that the shares will be available for trading.
Okay, sir. Thanks a lot and congratulations. All the best.
Thank you. The last question is from the line of Sandeep Pangal from Peace Sign Capital. Please go ahead.
Hi, can you hear me?
Yes.
Yes, we can hear you.
Okay, good. So I think first, great result, and thank you, Mr. Davis, for leading this bank through very turbulent times. But couple of things now that the merger is done, if you look at page 37 of your presentation, the post-merger shareholding has a lot of retail investors. I'd just like to understand what the strategy of the bank and the management with respect to sort of making this more institutional over time. I know there have been roadshows, etc., but some flavor on that would be helpful.
Some of the shareholders of the holding company are institutional shareholders. We have people like IFC, etc., who are there. And those will continue to hold the shares in the bank. But having said that, yes, you're right. We would like to increase the number of institutional shareholders. We have talked to a few people, and we hope that some of those discussions will fructify. Right now, we have about 33% to our institutional shareholders. We'd like to see that grow up to a better number. But yes, that is the objective of the management, to make sure that we get long-term institutional investors to take a reasonable share of the shareholding.
Okay, great. Thank you so much.
Thank you. As that was the last question, I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you, Muskan from Chorus, for your support on this call. And also, more importantly, Rikin Shah, who has been from IFL, who has been supporting us. As this is my final session with you guys in the last 8 quarters. Thank you for all your interesting questions and also being part of the journey. And wish you all the best.
Thank you.
Over to you.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.